on Queen City News Plus, your go-to show for everything in real estate. We talk about the latest market trends, do's and don'ts of the industry, and provide expert advice on navigating this dynamic landscape that we call home. No matter how many episodes we do here on Turnkey, the questions that most of our viewers have is about that first-time home buying experience. Should I buy now, or should I wait a little bit and rent and then buy later? What are the numbers? What do they look like? Well, we got the guy to talk about it here today. Cole Schweitering is a loan officer. And Cole, you've been on Turnkey before, so we didn't scare you away the first time. Welcome back.
Thank you so much for having me back. We have a lot to talk about, don't we?
It's been kind of a wild season when just with rates lately, it seems like they keep going up, and now all of a sudden they're starting to go down with the good news, I'm assuming, out of Iran.
Yes, that is correct. Yeah, it's been a wild couple weeks with the start of everything in Iran. And so things went up, things will trend back down, then something else will come back out, they'll go up again. It's just a very volatile time. So.
How do you keep up with it?
Oh man, just living in the space every day is really the only reason I keep up with it.
When rates do go down, do you then call your clients and say, hey, I think we need to lock it in now?
Yeah, so I'd be a little careful with that, right?
Okay.
I figure out their risk profile. Can they afford if rates go up a little bit, versus the reward if rates go down? Because it's really hard to navigate. So I just educate them and then give them the decision, right? Here's the numbers. Here's what could happen both ways, and then let them make that educated decision. But I don't really love to gamble because it's so unpredictable right now.
Oh, I mean, it's crazy. You think of someone who's shopping for their first home right now. It's stressful enough to try to figure out the home buying process, right?
Yeah.
There's the mortgage side of things, is what you can afford and what that payment looks like. And you're comparing rates, and sometimes they're not the same going from one loan officer to the other. And sometimes when you get the printouts look different. So you're trying to figure that out too. So it's a lot to think about. Not to mention the volatile environment that we're in right now.
You're so spot on. And it's a different conversation too. If somebody's really tight on debt to income ratio, and they may, if rates go up a little bit, they may not qualify. That's a whole different conversation, right?
Yeah. So I'm sure you get the question all the time from potential new clients is, what is the difference if I buy now or I buy later? Maybe I save a little bit and I buy later. You have provided us with an excellent comparison of what that actually looks like, buying versus rent. And there's a lot of numbers on the screen.
There is. Yep.
Don't worry, we're going to take our time and go through this in detail. So hang with us. So Cole, I'm going to make this full screen.
Yep.
What are we looking at?
Yeah, so let's talk through this. You hit the nail on the head. Actually, this is the buy versus rent.
This is the buy versus rent. Okay.
You want to go that direction?
Yeah, let's
first?
go that route.
Let's go buy versus rent. So this is a common question that I get, right? Is people are like, should I buy now or should I rent? And
houses are expensive. I don't know if I want to pay for when something breaks. When I rent, everything's taken care of for me. However, rent is 100% interest.
Correct.
So this is that comparison.
Correct. Yep. Spot on here. So really the question to be asking yourself is, what is renting costing you? Okay. So when we go through these examples today, what I did was I just did a $450,000 purchase price.
Okay.
Putting 5% down, right? To give you some perspective here.
That's a purchase price right up there.
Yep,
okay.
Purchase price right up there. So what we're going to look at today is a couple different factors that happen behind the scenes, which makes home buying such a powerful wealth building tool. Okay. And so when you look down a little bit here, you're going to see what the mortgage payment would be year one versus renting. Okay. So what I was using for a rent payment is $2,700. Okay. Because that's about, on a $450,000 house, depending on where you're at in Charlotte, probably what you're going to pay or somewhere around there. Okay. And then it includes the rental insurance in there as well. So what you're going to notice is on the surface in year number one, you're going to see that it is cheaper to rent than it is to buy a home. Okay.
Right.
But
adding everything up there.
Correct. But remember, owning a home, it builds wealth over time. It's not a get rich quick scheme. Okay. So there's some things behind the scenes that benefit you over time on purchasing a home. Number one is appreciation. Okay. So every year that you own that home, ideally your home's going up in value. So this example here, I believe uses, it's like 3.5% is kind of what we see with historical appreciation here in Charlotte.
3.21, I believe, is what you have in the upper left-hand corner.
So even a little bit more conservative than that. Okay. And this is over a 9-year outlook here, okay?
Hmm.
And so if you look up there, after 9 years of owning a home, you would have about 147,000. I'm having a hard time seeing it, but
147,989. Your screen is a lot smaller than mine. And
no worries. No.
hopefully at home you got a bigger TV.
Thank you for clarifying there.
Yeah.
So 147,000
I could probably
and some
zoom in a little
change.
bit more here. There we go.
Yep, perfect. And then there's a second wealth building tool with owning a home, right? So you have appreciation, your home's value going up over time. Number two is what we call amortization. So
Hmm.
every month, every time you make a mortgage payment, a portion of that mortgage payment is going down to, going towards paying down your principal loan balance.
Hmm.
Okay,
Principal loan balance would be, let me see, where do we have it here on the screen? Because it's a $450,000 purchase price.
that's correct. Are you looking per payment?
Yes.
Yeah, go down real quick.
Okay.
You'll notice year one, it breaks it out there. You got your principal versus your interest.
Okay.
So
Mhm.
$410 versus the 2,292, I
Right.
believe. Yep. Now, over time, what's important to understand about a mortgage is interest is front loaded. Okay.
Right.
So on a 30-year fix, you're going to pay more interest at the beginning of the term than you will as you go along. So
Mhm.
you're going to notice, like year 5, for example, you're now starting to pay more principal than you were in year 1, and et cetera, the longer you
Well,
go.
and at some point here, they're going to cross in the middle
Correct.
and it's going to
Yep.
invert. So then at some point, you are paying more toward your principal, so your equity portion,
Yes.
than you are interest, which is just money that's flying out the window.
That is
Not
100%.
maybe not on your end, but for the
100% correct. Yeah, and this would be a good plug. This is why it's powerful if individuals have the capability
Mhm.
to make a little extra payment towards principal each month or at
Mhm.
least once a year. It can be a powerful
Tax
tool to
season
cut
is a
down on
great
that.
time to think about that. If people are getting a refund, it's already money that isn't in your bank account. A lot of people put that toward their principal for their home.
You
Yeah.
hit the nail on the head. This is the perfect time of year if you come into a tax refund and you have
Mhm.
that capability, do an extra payment. It's going to save you a ton in interest over
Over
the life of
time.
the
You
loan.
might not notice it
Correct.
right out of the gate, but over time, you're cutting years off of your 30-year mortgage, probably.
Yep, you are
Yeah.
correct.
So we talked about the difference in payments from year 1, year 5. What are we seeing here when we are comparing the overall expenses of the home and your mortgage payment versus rent?
Yes, yes. So what this is going to capture here is it's a capturing the gain in appreciation,
Mhm.
the gain in amortization, and as well as the cash flow difference. So one thing I wanted to point out is we all know as renters, rent doesn't stay the same for 9 years, right?
Mhm.
Rent costs are going to go up year
I
over
mean,
year.
pretty much right around 5%,
Right
right?
around 5%.
Okay.
So my example might be a little bit to the higher side.
Okay.
This was using an average of 6% each year,
Okay.
but the numbers will change, but not by much.
Mhm.
So pretty much, year one, yes, it is cheaper to rent a home than it is to buy a home. However, by the time year 9 comes around, you're going to be paying more in rent than you would for your mortgage payment. Because
Mhm.
one thing people need to know about a 30-year fixed rate mortgage is that principal and interest portion of your payment stays the same. Okay,
Mhm.
because you're fixed on that interest rate.
Taxes really are the only thing
Now,
that changes,
taxes and
right?
insurance
Yeah.
can go up over
Yeah.
time, but this example even factors that in, where you see property taxes and insurance, you'll notice
Mhm.
that increases over the year.
Mhm.
So just to kind of put a bow on top here, because the audience can kind of take a look at this and break it down, when you factor in that appreciation gain, that amortization gain, cash flow difference, and then it even looks at the negatives, right? The cost to close on a home
Mhm.
and the cost to sell a home, you would have a net gain of buying a house of over 202,000 if you kept that house for 9 years.
Mhm.
So you can see that that's a powerful wealth building tool over time.
Well, and it's quite the swing when you're talking about a home that appreciates. And this is, excluding a big 2008 moment,
Yep.
right? When you're talking about the year over year appreciation of that property and then rent that continues to go up, that could be an 8% swing.
Yes,
I
very
mean,
much
that's
so.
significant.
Very much so. Yeah,
Yeah.
I'm passionate about it. I mean, there's the statistic I think that came out in the NAR National Association of Realtors report
Hmm.
last year that the average net worth of a homeowner is 43 times greater than that of a renter.
Hmm.
And this is the perfect example. You really got to kind of dive deeper into it to see that because a lot of people just stop on the surface and they're like, hey, like it's cheaper to rent right now than it is to buy.
True.
Yes, that's true, maybe
True.
year one, but if you're planning on owning a home for some time, right?
Mhm.
3, 4, 5 years,
Right.
you can see where like this can really build some wealth for you.
Mhm. So, it sounds like you're on the side of you should probably buy a home.
Well, yes. Now, it really depends on your financial situation. I'm the
Right.
first person to, when I sit down with individuals, if
Mhm.
it's not the right time to buy, we're never going to push you to that. But however, if you're in a good situation and you've saved up and you're ready to buy, you're just kind of maybe waiting, which will be our next topic for rates to go down.
Right, right.
We're going to have a different conversation. Why not go ahead and enter home ownership now?
All right, I've got it all queued up right here. This is buy now versus waiting. This is just year 1. So, you're saying the benefit of buying now for this particular scenario is a basically $10,500
Yep.
difference. Why?
Yeah, so let's talk about this real quick. So just going back, same parameters here. It's a
Mhm.
$450,000 home,
Okay.
5% down. Okay. And I'm using a 6.5% interest rate. As we talked about, things are very volatile. Could be a little different when this episode comes out,
Mhm.
but this will give you a good illustration here. So, what this is going to consider here is rates decreasing to 5.875%. So, that's what I'm saying. Maybe rates will be in a year. No
Okay.
guarantee, but for the illustration here. So, remember on the last part of this segment here, we talked about home appreciation.
Mhm.
Okay. Home appreciation is the big key in this. So if you buy that house at $450,000 today, assuming the
4, 5.
3.45% appreciation
Mhm.
rate, that home's going to be worth 465 and some change. What's
Yeah, 465. You've got 465, 512 is what you've
true?
got.
Yep, perfect. So let's just say 465, right?
Okay.
And so in a year, that home's going to be worth 465. Okay. So that's your appreciation gain that you would have by
And
buying now.
and keep in mind too, you know, 3 4% is conservative,
Correct.
right?
Yep.
I mean, during COVID, now I I almost hate using that example, but there were properties that were seeing 20% appreciation
Yes.
for 1 year.
Yes.
So that number can fluctuate, but that 3.45, I feel like that's pretty conservative.
I think it's a pretty conservative average. You're right. We've
Mhm.
seen upwards of 10%, and even in hard times, maybe just 1%. So
Mhm.
3% gives us a
Right.
nice conservative average. So that's why I think this is a good illustration, like
Okay.
even at 3%. So a couple things we want to consider, right? The appreciation gain, which is over $15,000 just in appreciation alone by buying now. Now, okay, now we got to look at the other side of this, right?
Mhm.
So if rates were to drop to 5.875 and you were to wait, you're only going to be saving about $77 per month. Okay.
Okay, so the box on the right is
Correct.
factoring in if rates drop a whole percentage point from
Almost. So
because this is what, 6.
6.5 down to 5.875.
Oh, okay. So
Yep.
okay.
Yep.
So you're saving 77 bucks a month for that swing, which I think is a significant swing.
Yeah. You would think it's a significant thing,
Yeah.
but it really doesn't change the payment as much as you think. Don't get me
Mhm.
wrong. We'd all love to save an extra $77 a month, right?
Mhm.
But with that being said, it's not a huge change. So we're going to factor that in. That's if you annualize that over 12 months, that's $924 of savings. Okay.
Mhm.
And then we're also going to factor in the cost of refinancing, right? Because remember, if you buy now, you're always eligible as long as you can credit qualify and income qualify to refinance at a later time. So
Okay.
let's factor that in as well, the cost of
So I
refinance.
buy now at, and remind me what the interest rate was for
Six and
the
a half percent.
6.5%. I get that 15,000 in appreciation.
Correct. Yep.
And then I refinance next year, let's say at
7.5. Yep.
5.875. What does that kind of I'll calculate out to be then?
Yeah, so the delta here, the benefit of buying today versus waiting a year for rates to drop to call it 5.875 is over $10,000. Okay.
Mhm.
The power is in that appreciation because the cool part is once you own that home, you can always refinance, right? As long as you qualify. What you can't do is you can't go back and buy that house for what it was worth last year.
Right, right. Which we know once we get to anything that starts with a 5 for interest rates, buyers flood the market because it looks good.
A 100%. Yep.
And then, what we traditionally see on the real estate agent side is there's more competition, there are more buyers, and then the price of that home goes up.
That's correct. Yeah. And it seems like, the last year and some change, it seems like almost 6.25 has kind of been that line in the sand.
Mhm.
Like activity picks up at like 6.25.
Mhm.
And so there's been a couple times over the last 12 months where we've touched the fives. And I can
Mhm.
tell you from like an application standpoint, there's a lot more home buyer interest.
Mhm.
So guess what happens when there's more interest, it increases the demand, things get more competitive in the market again. So, right,
Mhm.
hence the appreciation, your home going up in value.
Yeah, and then you end up paying more for a home, and then your mortgage payment goes up, or you have to find a home that's less expensive because you're gonna be paying more for that
Yes.
house to begin with. So we have one more scenario here that I want to bring up. It's the cost of waiting. You provided this as 2 years.
Yep. 2 years.
So what is the difference between what we just looked at and this one?
Yep. So same purchase price, same down payment, using 6.5% today. And I actually did a 5.25% rate in 2 years. Right.
Okay.
So that is over a full percentage point and some change. And so this is going to do the same exact illustration. It's going to look at the appreciation gains over that 2 year period. And then on the other side of things, it's going to factor in the monthly savings, which is what, 100 and you can see it better on your screen, 100 and
65 a month?
$165 a month. And so the same exact thing. It factors in the amount that you would save each month, as well as the cost of refinancing. And over a 2 year period, even if rates drop to 5.25, there'd still be a net benefit of over $22,000.
Mhm. So, do you feel like when you're talking with, potential clients or just out and about chatting with people in town, do you think that people understand this?
I don't. I think people look at things surface level, which is totally fine, right? If you're not in the mortgage industry, you're not necessarily expected. They don't teach this stuff in school.
Mhm.
And so you think of these things on surface level, automatically your brain says, higher interest rates, I probably shouldn't buy right now. It doesn't make sense. Let's
Mhm.
wait for things to drop. And that's what stalls people's decision. Same thing on the buy versus rent scenario, right? On the surface, renting appears cheaper than buying. People don't really like pull back the rug and see the benefits of home
Mhm.
ownership over time.
I think too that monthly payment, when you're paying rent and you're basing your expenses off of what you make, what you can afford, and you're used to that rental payment, it can be intimidating thinking
Yeah.
about buying a home and that payment's going to change and it's going to go up. And if the scenario kind of like what we presented, you're paying more per month than you in if you're buying than you are if you're renting. That's a tough pill to swallow for people.
Very much is a tough pill to swallow. Now, I tell people though, it's like when you buy a home, think of the amortization, paying down your principal loan balance. It's a little bit like a forced savings account, right?
Right,
Because
right.
every month you make a payment, a portion of it goes towards principal, and you're kind of paying yourself back in the form of creating equity.
Mhm.
Whereas if you're a renter, unfortunately, you're not getting any equity, right? Or if anything, you're paying for the equity for your landlord.
Mhm.
So
Yeah.
I'm very passionate about home ownership. I mean, if you just look back
I would hope so.
years and years. They got like long, long outlook,
Yeah.
right? I mean, people have created generational wealth through real estate.
Mhm.
So I'm a firm believer if you're in a position where you feel comfortable making that jump, I would encourage you to do it.
So, let's talk about the rate situation. What causes excluding the chaos of
Yep.
what we've experienced the past month or so, what traditionally causes rates to go up and down?
Yeah. So, really, two things. It all comes down to the Federal Reserve. Now, it's
Mhm.
important to know that the Fed does not set mortgage rates.
But every
However,
time the Fed lowers rates, everyone gets all excited, right?
correct, correct.
Why is that?
Exactly. Now, what the Fed does, influences the mortgage market over time.
Mhm.
And I must say that the mortgage market is always forward looking. So, what I mean
Mhm.
by that is the mortgage market's going to move before the Fed ever moves, right? They're
Mhm.
trading on speculation of what the Fed's going to do.
Mhm.
So, going back to your initial question, what really moves mortgage rates? Two things, it's inflation and it's jobs, okay? Because the Fed has a dual mandate: maximum employment and keeping inflation at, they say, 2% is their target level.
Mhm.
So, really, the reason why we've seen rates jump, taking the whole Iran stuff out of it, which does influence it, is
Mhm.
inflation.
Mhm.
So, right now, inflation is quite a bit over the Fed's 2% target. So, immediately they're like, okay, I don't know about the rate cuts. We got to get
Right.
inflation under control. However, they got a tough job right now because on
Mhm.
the other side of things, the job market is not performing as expected, right? It
Mhm.
may look strong on the surface, but when you kind of peel back the curtain,
Mhm.
the jobs market is not doing as good as expected. So now the Fed says, shoot, which part of this dual mandate do we kind of focus on?
Mhm.
And I would argue that right now inflation is a little bit more of their focus. So unless we start to see further cracks in the jobs market, I think the Fed's going to kind of sit tight and see what happens here.
So what about the 10-year treasury yield? In explain what that is and why there seems to be more of a focus on that for mortgage rates than anything else.
Yeah, so I think the 10-year treasury yield's just a little bit easier to track.
Mhm.
So it kind of moves in unison with mortgage rates.
Mhm.
Don't want to get too far into the weeds with this, but with that being said, it's like as you see the 10-year treasury yield go up,
Mhm.
typically mortgage rates are going up.
Okay.
As you see the 10-year treasury yield come down, mortgage rates are coming down.
So everyone wants to know, like, what is the crystal ball of rates? Where are they going?
Yeah,
What are your
so,
thoughts?
goodness gracious, if I had a crystal ball, I'd be on a beach living in paradise somewhere, right? Now,
Yes.
I do think realistically, looking at the low of this cycle, I do think once things kind of sort itself out, we could probably get back into the high fives.
Mhm.
Everybody that's rooting for the mid to low fives, which by the way, I'm rooting for that as well. However, I will tell you, it's going to take something to happen in the economy,
Mhm.
whether it's the jobs market cracking or we really get inflation under control. So realistically, if you're looking to buy in the next year or so, I would have your expectation that rates will probably kind of hover somewhere in that higher 5% range.
So what is your suggestion then to someone who's sitting on the sidelines and they're unsure about whether or not they should buy a house or rent? If they at least want to kind of explore it and find out some answers, what is their next step?
Yeah,
And tell me about how scary it is.
Yeah, 100%. Well, next step would be to consult with a mortgage loan advisor,
Mhm.
somebody like myself, whoever's trusted in your circle. I think it's always good to have a conversation and let them illustrate some numbers to you like we did today.
Mhm.
And I will tell you, like, if you're moving to the Charlotte area or if you live in the Charlotte area and you're
Mhm.
planning on staying here for some time, look into buying a home, right? Now, if you're somebody who maybe might be moving in a year or two for a job relocation, maybe it doesn't make sense to purchase yet,
Mhm.
right?
Mhm.
So yes, reach out to somebody you trust and just kind of look at the numbers and weigh the decision if it fits, your goals.
So what does that look like? You get someone who calls you and says, "Hey, I'm thinking about buying a home, but I don't know where to start." What are you going to ask them to
Yeah.
submit? What does that whole pre-approval look like?
Yes, I'm glad you asked that. So we're always going to start off with a discovery call. And the purpose behind that discovery call is to learn a little bit more about your home ownership goals
Mhm.
and to learn a little bit more about you in general, right? So we can kind of have an idea of how to structure this mortgage and get things prepared to benefit you. From that discovery call, we will then typically have you submit a mortgage questionnaire. It's where we can
Mhm.
kind of gather all your information in one place. And then we will do usually a soft credit check. That's where people get worried. Now, it's important to understand that a soft credit check does not impact your score like a hard credit check. Just
Okay.
like going to Credit Karma and how it pulls your scores,
Right,
that's a
right.
soft credit check.
Okay.
Okay. So really no harm, no foul to take that next step
Mhm.
to see what you may qualify for.
Mhm.
And once we have a chance to review the questionnaire, we then do what we call an initial loan consultation, which is where we'll jump on a Zoom or a phone call and we'll walk through your questionnaire together and start putting together a budget and
Mhm.
showing you the different options that are available to
And
you.
how much does all of this cost?
Absolutely $0.
Okay. So there's no risk in it's not like you're no offense to the attorneys out there, but it's not like you're setting up a $500 hour-long consultation with an attorney. This is all provided to you in hopes that they would be your client at some point.
Exactly, right? We're here to earn your business and to be advisors to you. Yeah,
Mhm.
we don't get paid a dime unless that mortgage makes it to the finish line.
Okay. Which I always think about that. The people who do inspections on the home,
Yeah.
they always get paid because they're providing the service and we have to wait until the closing day. And sometimes that falls apart the day before or the day of. You just
Yep.
never know. Okay, so they submit all their kind of financial information to you. You calculated it and you spit out a number and say, "Here's the max of what you can afford." Right? Is that how that
Yeah,
works?
exactly. Well, we're going to look at your max, but in that discovery call, I must add, I always go a little deeper. It's like, even though we can maybe qualify you for X,
Right.
what are you going to be comfortable paying from a
Mhm.
mortgage
Mhm.
perspective? What I'm seeing right now is a lot of times it ends up being a little bit more of a balancing act. they can afford more, but they don't want to pay it.
Mhm.
And we're not here to push them to go to that higher purchase price.
Right.
We're here to put together a scenario that fits their budget goals.
Because at the end of the day, you want them to make the payments too. I mean,
Exactly.
that's-
Yes.
You want
Yes. We don't.
success. Everyone wants success around here.
Correct. Exactly.
Yeah.
We don't want to put you into a situation where you're going to be uncomfortable. And there's even been times where I've had to kind of talk people back down. It's like, look, you told me your comfort range was $2,500 a month. We're at $3,000 at this purchase price.
Big difference.
Maybe we need to tone it back a little bit. So
Yeah.
it's a lot of setting expectations, right? And that's why we're here as advisors. We're here to educate you and give you everything you need to make an informed decision.
Well, I feel like you did a lot of that today on Turnkey, Cole. I really appreciate you coming on the show, and I think it was informative, and hopefully it helps the first-time home buyers out there get a better understanding of what they're jumping into when they're thinking about buying their first home.
Yes. Thank you so much for having me, Morgan.
Yeah, thank you everyone else out there for watching this episode of Turnkey on Queen City News Plus. We'll see you next time.
Queen City News Plus. Just search Queen City News on your smart TV's app store.